Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Bill English, professor in the practice of finance at the Yale School of Management, as well as former Federal Reserve official. He joins me to discuss the risks the Fed faces as it considers policy options. Bill, it's great to have you with us. Welcome to Trade Talks.
Thanks very much, Jill. Happy to be here.
All right, you got it. And thanks for joining us. And before we get into Fed policy here, let's get some background in terms of where we came from reopening the economy following the pandemic and where we are now.
Right. So as you know, Jill, the pandemic hit the economy hard. It got very weak. The Fed was worried that it would stay weak for a long time. And so it provided a lot of accommodation, eased monetary policy a lot. There was also a lot of fiscal policy accommodation provided. And the result was that the economy recovered more rapidly than people had expected. It came back strongly. And that, coupled with the disruptions to supply that came as a result of the pandemic, meant that we ended up with very high levels of inflation a year or two ago. So the Fed had to pivot, and the Fed pivoted pretty sharply. It turned to tightening monetary policy. It raised rates more than 5 percentage points over the last 18 months. So it's been a big shift. The intent, of course, being to slow the economy, bring supply and demand into better alignment, and help bring inflation back down towards the Fed's desired level, which is 2%.
And Bill, from a historical perspective, the rate at which the Fed increased, is that relatively, is it faster than you've seen in past rate hike cycles? It feels as if it almost took the market and the economy by surprise just by the rate at how quickly they were moved up.
You're absolutely right, Jill. It was a very quick adjustment. I think there was a period in the early 1980s when Paul Volcker was chair and was responding to the really, really high inflation we had back then, when rates went up a bit faster. But it was a very rapid rate increase. And as you probably remember, the Fed was moving in 50, even 75 basis point steps for a while there to get rates higher. They I think felt they'd fallen a little bit behind. They initially misjudged the inflation a bit, and so they had to move quickly to get to where they thought policy should be.
I would imagine, Chair Powell does not want to make, he wants to remember some of the mistakes that we've seen, historically, and not make that pivot too quickly to move back into lowering interest rates either. I mean, I think the market has very short-term expectations where they want to see policy play out. We're just so used to instant gratification these days, but it does take time. It does take cycles for these rate hike policies to make an impact to the economy, doesn't it?
Absolutely right. So one of the key issues for the policymakers right now is the lags with which monetary policy operates. So there is a lot of work that shows that monetary policy changes today have their full effect on the economy in a year or even 2 years from now. And so one of the things the Fed's trying to do is it's calibrating its monetary policy right now, is taking account of the fact that they raised rates very rapidly, very strongly a year ago, and the full effect of that tightening hasn't been felt yet. And so they're worried, surely, that if they keep tightening until they see the economy slowing, until they see inflation coming down further, they could well tighten too much, and they could end up with an economy that ends up in recession.
So let's think about the risks and the complications here. As it considers its policy options, it does face risks in both directions. Perhaps even their 2% target rate is a little bit too low based on the environment we're in.
So they definitely face risks in both directions. As we were just discussing, it's easy to imagine scenarios where they tighten too much and they end up with the economy going into recession. In that case, they'd have to pivot again. They'd have to ease policy to try to get the economy to strengthen. On the other hand, I think they're quite worried that the economy could just stay strong. They've been surprised by the strength of growth this year. They've in some sense been wrong about that. They thought they were going to get a bigger slowdown, and if they continue to see stronger growth than they currently expect, you could imagine the economy stays strong, inflation stays high. It starts to get built into wage and price setting by businesses and households. And then we know from the experience of the 1970s and early 1980s, that's a very costly problem, because then to get inflation down at that point would likely require a recession. It would require a period of a very weak economy. They'd like to avoid that for sure. Now, you raised the issue about the 2% inflation target. Is it too low? I think there's a debate to be had about that, but the Fed has not been willing to entertain that debate. They've made it clear they're sticking with their 2% objective. They really want to get inflation down to 2, not tomorrow, but say over a year or two. And they seem to me to be fully committed to that target.
So we know their mandate is two things, right? It's employment and it's inflation. What about the heightened geopolitical environment that we're in right now? Does that have any influence on Fed strategy?
I think it does. I mean, there are a couple of things going on. One is, of course, the war in Ukraine and the possible spillover effects of that on commodity prices, on oil prices and food prices, which we saw when that war began. And now, of course, there's fighting going on in the Middle East. Again, that puts oil prices potentially under pressure. So you could certainly imagine if the geopolitical situation deteriorates, there could be a pretty big impetus to inflation coming out of commodity prices, and that would make the Fed's problem much more difficult. As you said, their objective is to balance kind of low and stable inflation against maximum employment. If we get a big boost of inflation from these geopolitical problems, that makes it really hard to balance that with maximum employment. At least in the short run, they need to slow the economy to get inflation down, and that would potentially mean they wouldn't achieve that maximum employment objective for a while.
All right, Bill, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks very much, Jill.